Ethan Anderson, you run about $2 billion for your clients. How are you advising them right now, considering all that's going on in the world right now?
Well, you hit the nail on the head. With everything that's going on in the world right now, diversification is of the utmost importance. And people have been talking about diversification for decades. But in this current environment, with the amount of ETFs and exchange-traded notes that you have access to very easily, the average investor can get commodity exposure, currency exposure, market-neutral exposure. Because when you take a look at the current environment, you're absolutely right. There's a lot of headwinds that we're seeing out there that could potentially knock the markets further down. But there is also a lot of positive things taking place too. They don't get as much press, but you've got corporate earnings knocking the cover off the ball. We just had a wonderful corporate earnings season. Emerging markets, granted, things are getting a little bit soft, but they're still growing at great guns. There's a lot of positive going on right now. That being said, also a lot of storm clouds that could start raining on us at any minute. So our answer to investors right now is to be able to make sure it's not an all or nothing prospect. Have some money in stocks, have some money in bonds, but you know what? Have some money in some other places as well that you might not normally invest in.
Well, you mentioned ETFs. Let's talk about one ETF that you like, and that's the XLV. It's the Healthcare ETF. Why do you want to be involved with healthcare right now when everyone's talking about Obamacare and it's still under review from the Supreme Court?
If you read some of the headlines on the healthcare industry right now, it looks like the healthcare industry is going away completely. Nobody's ever going to get sick anymore. Nobody's ever going to need to see a doctor, which is obviously a ridiculous way to look at it. You've got the baby boomers make up the largest, wealthiest portion of our population today. They're going to get sick. They're going to need more operations, and they're going to be willing to pay for them. Whether or not it's Uncle Sam cutting a check or the individual patient, the healthcare is going to get paid. And when you take a look at the relative valuations of the healthcare industry today, they look very attractive. And what people forget, last year, before the Greek crisis reemerged, healthcare was leading the pack from a sector standpoint, yet wasn't getting any of the play in that area. Now, the thing about healthcare, too, that a lot of people forget, it's a wonderful inflation hedge. Because if prices do, in fact, start going up, what are you going to go do? You're going to go spend the extra money to go see the Avengers in the movie theater, or you're going to get that hip replacement.
Well, you also like the IYW, which is a technology ETF. Technology has done very well so far this year, but will that start to decline once Facebook goes public and a lot of the headlines go away?
You know, the Facebook story, I think obviously it's a tech company, but there's a lot of other good stuff going on besides Facebook in that sector. Number one, what the financials just went through a few years ago, the tech companies did more than a decade ago with the tech wreck. You saw a ton of companies, of course, get bought up, and then you had the tech bubble burst. And those companies learned from that scenario. Those CEOs learned from that situation. You take a look at the current large tech companies, they are cash rich. They have very strong balance sheets. They'll be able to withstand any type of economic downturn, generally speaking, and come out okay. And the other beautiful thing about technology in the current environment is there's no other sector that can go and create their own markets. You didn't know you needed an iPhone until Apple came out with it. You didn't know you needed an iPad until they came out with it. You didn't know that you need a ton of stuff in the technology environment until somebody comes out with it. And that's the beautiful thing about tech, is no other sector can do.
All right, so finally, which sectors don't you like? What are you avoiding right now?
From a sector standpoint, we're not big on financials. They're leading the pack, of course, so far this year. We think it's more so because of the situation being less bad, meaning that the situation doesn't look anywhere near as negative as what a lot of other folks were saying. But you take a look at some of the fundamental aspects about the financial sector, and you realize there's going to be some long-term issues. Over the last 30 years, we've seen interest rates fall. We've seen in our clients' portfolios, they have large bank positions because these banks, seem to always be able to make more and more money year after year in a very stable environment. Well, what we know is that with interest rates falling, that was giving the juice to these financial institutions. It was making it more attractive to refinance your mortgage and create a fee from that standpoint. It was making it more attractive for business owners to take on financing to be able to fund new projects. What is this sector going to do in a flat to rising interest rate environment over the next 30 years?
This market is
stock pickers market.
Stocks have rallied this year.
We're coming into a Monday where we're going to